All right, let's dive into one of investing's classic puzzles, the energy sector. It's a world with massive potential for gains, but man, it can also feel like riding the world's wildest roller coaster.
So that's the big question, isn't it? How do you tap into all that upside in the oil and gas world without getting totally wiped out by those crazy price swings? Well, it turns out if we look at two Canadian giants, we might just find a really clever solution. Let's get into it. Here's how we're going to break it down. First, we'll look at that core problem, the price roller coaster itself. Then, we'll introduce our two titans and their very different game plans. We'll see how they act when prices are soaring, and maybe more importantly, what happens when they crash. And finally, we'll see why putting them together might just create a power couple for your portfolio. Okay, so first things first, let's tackle the fundamental challenge. For any energy company, the price of the commodity they pull out of the ground is pretty much the biggest factor that drives their profits. And that price, it is anything but predictable. And if you want to see what I mean, just look at this. In the second quarter of 2024, a barrel of West Texas Intermediate oil was trading over $80. Fast forward just 1 year, and it's plummeted 21% to under $64. A swing that big has a huge impact on a company's bottom line. So how on earth do companies deal with this? Well, let's meet our two case studies for today. Canadian Natural Resources, we'll call them CNRL, and Imperial Oil, or IOL. They're in the same business, but their playbooks could not be more different. So on one side, you've got CNRL. Think of them as the producer. Their main focus, their whole game, is getting oil and gas out of the ground. That's it. This means their profits are tied directly, and I mean directly, to the price of oil. Then you have Imperial Oil, the integrated. Their business covers the whole spectrum, from pulling crude out of the ground, which is the upstream part, to refining it and selling it as gasoline at the pump, which is the downstream part. This structure gives them a kind of built-in shock absorber. And you can see it plain as day in CNRL's numbers. For the first half of 2025, look at that, their production businesses brought in over $5.8 billion. Their refining business, it actually lost a little money. This tells you everything you need to know. For CNRL, it is all about production. Now, compare that to Imperial Oil. In that same time frame, their production side was still the biggest moneymaker at almost $1.4 billion. But look at their downstream business, refining. It brought in another $906 million. It's just a much more balanced operation. All right, so let's run through a scenario. What happens when oil prices are high? The good times, when the market is absolutely booming. For a pure producer like CNRL, this is fantastic. It's actually pretty simple. When the price they get for every single barrel they sell goes up, their revenue skyrockets right along with it. Their costs don't really change much, so their profits can just explode. So here's the key takeaway. When oil is rallying, both of these companies do great. Imperial's production arm makes a ton of money, just like CNRL's. But a pure producer like CNRL has what you'd call more torque to the upside. Their earnings are going to react way more dramatically to that price spike. But as we all know, that roller coaster has to come down sometime. So what happens then? This is where the difference between these two strategies really starts to shine. For producers, falling prices are brutal. The money they get for each barrel shrinks, but their costs to get it out of the ground are pretty much fixed. That puts a massive squeeze on their profits. And that is the whiplash we were talking about. But check this out. This is where it gets really interesting. This line comes straight from Imperial Oil's official report. They're saying that their refining margins actually got better in Q2 2025. Now, wait a minute. Remember our earlier slide? That was a time when crude prices were falling. So how is that even possible? It all comes down to this idea of the downstream cushion. See, for Imperial's production business, crude oil is a product they sell. But for their refining business, crude oil is a cost. It's the raw material they have to buy to make gasoline. So when crude prices fall, the very thing that hurts their production business actually helps their refining business by making its main ingredient cheaper. And you can see that cushion right here in action. Even when the price of oil might be weaker, that downstream business is still a huge profit center. It provides this incredible buffer against weakness on the production side. It just smooths out the entire ride. So let's bring this all home. We've seen how these two strategies work differently. Now let's talk about why that makes them such an amazing combination to have together. So here's the bottom line. CNRL, the producer, is your offensive player. It gives you that high-octane exposure for when oil prices are taking off. Imperial Oil, the integrated, is your defensive player. It provides that cushion, that resilience for when prices fall. Owning both means you have one company built to capture the boom times and another one built to withstand the bust. And that kind of leaves us with a final, pretty interesting question to think about. We're always told to diversify by buying different industries, but maybe, just maybe, the smartest kind of diversification can be found by combining different strategies within the very same industry, creating a much more balanced, much more resilient whole. Thanks for watching.